This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, everyone. How you going? Phil Tarrant. I'm the host of the Smart Property Investment Show. I hope you're well. You probably heard me speak a lot about my relationship with my accountant over many years and just how critical accountants are to the life, health, happiness, financial success, security, relationships of all property investors. They're a pretty integral role when it comes to effective investing in property. And a lot of people sort of, blanket statement, but a lot of people often choose the wrong accountant for the purpose of property investing. They will have an accountant who's normally done their tax returns for many years, and most accountants' role for most Australians who either they get a PAYG income or small business to try and minimise tax, and that's not necessarily the best outcome for all property investors. I speak a lot about it on the show. We get a lot of feedback saying we want to know more about this and understand our relationship. So I've got a duo in to the studio who work in lockstep with their clients to ensure that they're making the right property investment strategy, buying decisions aligned with or with a view towards or in lockstep with the consequences of that, and trying to amplify that positively with their accountant. Moxon Reza, he's back joining me. He's the founder and managing director of Investor Partner Group, and he's joined by Sahil Merchant, tax director at Investor Partner Group. So we've got some heavy hitters here. We're going to talk about all these things and whether or not your property investment advisor should get on with your accountant. Sometimes that doesn't work, and I can see a lot of friction. Moxon, you're laughing. How are you, mate? Good to see you again.
I am great. Thank you, Phil. Thank you for having me on the show again.
Now, it's good to see you. And Sahil, we haven't met before. It's good to see you, mate. I always like chatting with accountants, so I'm pretty much going to use this as my opportunity to ask all those tax questions that I think about all the time.
Fire away, ready to go.
Which is probably pretty consistent with how most investors, they often speak to their accountant second, or as a secondary consideration to the glitz and glamour and excitement of buying property. And often that's the way it works out. Moxon, is that what you see mainly? People speak to their property investment advisor first? Typically.
I think a lot of people, either they would default to an accountant or a mortgage broker before they come out and speak to a property advisor. So it's almost like, you're putting the cattle before the horse, right? So you're going to make bad decisions, or you're going to make poor decisions, because accountant typically is thinking, or majority of the accountants are thinking from a tax minimization perspective, because that's their key measure of success. Save as much money as possible for this guy coming here today for a tax return. And, similarly, mortgage brokers, and astute mortgage brokers should always think about, okay, what are effective tax strategies, or what are the effective buying strategies that we need to play in the year coming forward, especially for SME and the businesses. So, yeah.
So we speak a lot about it on the show here around having a team of professionals to support you as a property investor. Would your argument be that the property investment advisor sort of sits in the middle of that and conducts and coordinates all the other aspects of it all?
Definitely. I think the property investment advisor typically is what's helping you make informed decision-making when it comes to, managing your property portfolio, whether it be buying or selling, or when to buy, what to sell. And they are playing a very important role in analyzing the markets ear to the ground, evaluating property values, and helping you build that property portfolio that is going to help you create the net wealth. And so they'll think about the tax side of things with the tax advisor, and they'll think about the mortgage strategy side of things to help you maximize returns and minimize risks. Typically that's where the PIA looks at should I say property investment advisor looks at the broader picture when it comes to property investments.
Yeah, it's not a bad way to frame it. I'm quite a visual person. And for those listeners out there, you could draw a bubble and put property investment advisor in the middle, and then all the interconnected components of that. Moxon, you must see it still, and hopefully it doesn't happen that often anymore, because people have access to resources like this where they can educate themselves on property. But do you ever get phone calls saying, oh, my accountant told me to go and buy a negatively geared property, so therefore I'm talking to you? That doesn't happen
all the
anymore,
time.
Does it still happen?
No, still do. Yeah, 100%. So, and it takes so much back and forth, especially like with the mortgage broker and accountant. I'll share one story where this particular accountant went in and lodged the returns, and this is for 2024 we're talking about, lodged the returns trying to keep their income as low as possible, which basically hampers with anything that they're going to buy next year. And so the mortgage broker is like, I can't help. Like, I know that this guy is making a turnover of 7 figures, but the books don't show that. Like the accountant is basically saving all of this money. And so it's not helping you grow the property portfolio. And so I had to have a really interesting conversation with the accountant saying, well, this is not going to work because, what is he going to do all of this cash if he don't have access to leverage and debt? And so I think that plan in place, typically what I tend to do always is, especially when we are onboarding new clients, is we would say, look, if you have an accountant, well and good, let's set up a meet so that we can share your property plan with them. It's very important for them to know as to how many acquisitions are you going to make over the next sort of 5 to 10 years so that, they can plan it accordingly. It's not about tax minimization. It's always about, creating wealth and creating cash flow within the property portfolio.
How did that go down with the accountant? Was it a friction sort of relationship with them?
Well, they moved their accountant to us. So that's where it started. But yeah, it was a lot of fixing, right? You have to go back, redo their, books, redo their taxes. It creates a bit of flag with the ATO as to, you were disclosing nothing and now you're disclosing X amount of money in the profit. So, but yeah, you need to think about these proactively about how do you go around managing this. And, the mortgage broker and the property advisor plays a really important part and an important role in this.
Yeah. And this is something a lot of property investors won't like to hear. And that is, if you want to invest in property, you're going to have to pay tax. And tax in many ways is, it identifies you and it highlights you as someone who is making positive money and therefore paying a contribution out of it. If your accountant's just trying to minimize your tax, that might be right for you in a strategy you're focusing on. But if you want to, again, blanket statement, if you want to invest in property, you're going to have to pay some tax, and that's just reality of it all. And the tax office is right across this sort of stuff. It's the price you pay. Pay your tax, and then it's going to contribute rapidly to your ability to invest in property. How did you go with those particular clients, Moxim? It must have been a complete mindset shift. They've been told for years, pay less tax, pay less tax.
Pretty much. And I think Sohail played a really important role there in, how does the retained earning works, you paying that taxes, how does that really basically comes into play as well. So I'm going to defer some of these questions to Sohail so you can talk about retained earnings and this concept of you paying the taxes and still, declaring dividends in the future and passing on these franking credits, right?
Yeah, it starts getting complicated. And for a lot of people, they're bewildered by a lot of these tax sort of constructs. And I highly, it's not that tough to understand if you spend some time, energy, and effort, and a good accountant will educate you. And the better you are educated around the nuances of this. You don't need to be an expert in any way. That's the accountant's job. The better you can start thinking strategically about your portfolio. So the question I have for you, Sohail Merchant, welcome to the show, Tax Director at Investor Partner Group. How does an accountant's role differ when it comes to property investment, sort of when you look at it through the lens of what the property investment advisor does?
That's why it's the accountant's role in holistic way. They work with other professionals, the mortgage brokers and the property investment advisor, as Moxin mentioned, that when a client comes to you, he needs to strategize. Moxin is a property investment advisor needs to strategize your plan, and then you go to your accountant with that plan. And then if accountant understands your plan, then they can advise you accordingly what needs to happen in your taxes or with regards to your taxes, how you manage your tax efficiently, looking at your plan, because they understand the goal you are trying to achieve in next 5 years, 10 years. Same thing with mortgage brokers. I find it difficult sometimes when we're speaking to mortgage brokers as well, that clients want to achieve certain goals. They just don't want to reduce the interest rate there. They want to grow their portfolio. And to grow their portfolio, they need to follow this plan. So if an accountant is focusing on just negative gearing, then that plan is not going to work for the client. So that's why it is important to be part of that group or cohort there where everybody is looking after the client, what they want to achieve in their goals, for example. So yeah, as Mokshin mentioned, that you need to speak to your accountant once you have a plan ready, and then discuss how you can manage the taxes accordingly.
So you can do your job best if someone comes to you with a plan that they've created or developed individually or ideally in line with Moxin and his team. That allows you to get the best outcome, because then you can actually deploy the tactics you need to do in order to support that plan.
Correct. Yes. And I tell my clients most of the time, if you're making your life-changing decisions, let your accountant know. Okay. For example, if you want to get married, let your accountant know. If you want to do something else, let your accountant know. They can give you some advice accordingly, right? So as you mentioned, Phil, before, that they buy the property, they sign the contract, and then they come to us, and it's too late for us to give them any advice accordingly, right? And then they're stuck with that contract, and they have to purchase that property, and now they are locked out. They can't purchase further properties in future because they have signed a contract in a manner, or they got a loan in a manner that they can't grow their portfolio anymore. So yeah.
So the key point is that if people are proactive and think strategic about where they're going, the accountant can develop a plan to support that. Whereas if it's retrofitted and you're being reactive, it's a lot harder to get the outcome you want. It takes more time, energy, effort, probably more money as well. You'd rather not fix problems. You'd rather create opportunities.
That's true. Correct.
What do you like working with property investors the most?
I mean, look, the property investors, when they come to us, they usually, we need to educate them. They want to invest. They have cash there. They have passion there. They understand the property. They know that growth is going to be there. They just need guidance there. Okay. So what I love that when I tell them, look, I'm 99% of the accountants, they're going to tell you go to negative gearing. Okay. I tell them I go the other way. I don't worry about negative gearing. It's a short-term goal. If you have a long-term goal, or if you don't have a long-term goal, create a long-term goal, and then we can guide you accordingly. So education is very key in that sense, because it is just status quo. They don't want to change. When you have a relationship with your accountant, a long-term relationship with your accountant, you don't want to go somewhere else after a while. So it becomes difficult for them to leave that relationship, and then when we educate them, they understand, and then they come and they convert. So yeah, I mean, it is an exciting work as well.
I bet it is, and it must be satisfying. And accountants are known as the trusted advisors. Most people I know who are in business and or property or both have a pretty tight and close relationship with their accountant. My accountant knows everything about me, probably knows more about me than I do.
Yeah.
And it's a trusted relationship. And even through the COVID pandemic, they called accountants the doctors and nurses for business in Australia,
That's
right?
true.
They were on the front line. And no doubt you saw it. Sahil, they're on the front line really helping steer and navigate people's financial health and happiness around it. And if you get your accounting right, you're aligned with where you're going, you know where you're going, I tell you what, your life's a lot easier, isn't it?
That's true. Yes.
Yeah. How long have you been an accountant for, Sahil? What's the background for you, mate?
So I've been in industry for over 20 years. I'm a CPA myself. I started my own business about 15 years ago. My core business is self-managed super fund. I'm a self-managed super fund auditor as well. So I've been it's been a while in the industry, and relationship to Moxin it's about 10 years old when we started working on property developments, and we started working on some certain projects in the past. So I've been in the industry for over 20 years now as an accountant.
Yeah, it's look, and as a property investor, it's absolutely critical you have a good accountant. I was at a big accounting event recently, and someone come up and introduced themselves to me and said, "Oh, I actually audit your super fund, Phil." And I was like, "Oh, really?" We had a great old chat. It was and I thought their work was exceptional. And this is the point. Not all accountants are created equal when it comes to property investment or even SMSF advice. It's a completely different playing field. You've got to ensure, if you're serious about investing in property, that you actually get a property orientated accountant. And again, I might be generalizing, Sahil, but most accountants don't normally specialize in really supporting property investors. Is that a fair comment?
I would say that, yes, it's a fair comment that, look, as Moxin mentioned, that they are just focusing on tax minimization. Yeah. They are not thinking from wealth creation perspective, right? So when you speak to a property specialized kind of accountant, then they would talk to you about wealth creation, not just tax minimization. Yes, tax, nobody would like to pay tax. That's okay. I mean, you can create some strategies to minimize the tax or make it efficient work for you. You have to pay tax. As you mentioned, you have to pay tax. You can't avoid them. But how you manage them, that's a tricky part. So this is where the accountant roles come in, and they guide you, advise you. As you mentioned, as a trusted advisor, you need to trust them and let them guide you.
Yeah, and if you're going to have a good relationship with the accountant, you need to make sure you disclose absolutely everything, because then they can actually help you do the right thing. So there's no use hiding stuff away from your accountant. If they do that, they're flying blind. So
that's true.
Yeah.
And it's simple maths as well, right? I mean, if you really think about this, you pay like say 20 or 30,000 in taxes, for example, or say 60,000 in taxes for the year. And if you get access to leverage of say, 800,000 to a million, and that property or whatever that asset is grows by 5%, you've made twice that amount of money already, right? And, we know how property markets work and tend to work. And, if you buy in the right pockets and, buy the right asset class, typically the return on investment, even from a tax perspective, because I'll say tax is an investment, right? A lot of people think about tax as an expense. I would be like, nah, it's an investment because it gives me access to leverage, and that leverage is what's going to help me build my net wealth, right? So I think that mentality and mindset needs to propagate a lot better.
Oh, I completely agree. And if you're sort of struggling with that concept, ask your accountant to explain it to you. It's a really, and you see a lot of investors go, oh, okay, that's right. That's why I need to actually pay tax and don't go down a pathway trying to minimize tax. Got some other questions for you, Mox, and we'll just go to a quick break. Stay with us, back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show, having a chat with Mox and Reza and Sahil Merchant, tax director, and Moxon's obviously director over at Investor Partner Group. So how do you work together? Like, so Moxon, I guess it's a bit of a technical question, but what are the sort of 5 reasons, in your opinion, why it's essential to sort of speak to someone like you before you speak to an accountant? If you could just clarify that for me, just so we can be clear to our audience.
Look, the first and the foremost is having a plan in place. And so the accountant or a mortgage broker, either or, would always want a plan in place. They want to know what you're doing with your property portfolio over the next sort of, 2 years, 5 years, 10 years. And the property advisor basically helps you navigate through some of these things. Okay. So you're very clear and, you're providing tangible outcomes to this. Number 2, where an accountant would always question is, okay, how much do I need to should I say be creative when it comes to, creative accounting in putting the numbers up? What do I need to disclose to the tax office? How much do I need to, basically go? And accountants do have that sort of sway, how much depreciation benefits do they need to kill in? How much can they claim? So there are a lot of levers that they can pull. And so you or a property investment advisor being very clear together with the mortgage broker around, okay, how much is the servicing that we're looking for? That gives them quite tangible outcomes to achieve, from a financial perspective as well for the clients. And it's easier conversations to drive. Also, I think the periodic meetings with the property investment advisor and an accountant together typically means that it also sits with the sell side of decisions. A lot of people only think about the buying side of decisions, but also selling decisions are quite important too. How do you create multiple exit strategies for people? And how do you go around, selling or developments, typically around those sort of things? And when do you do it? I've seen people signing up the contracts, and this is so funny. I've seen people signing up the contracts in May thinking, oh, my property is settling in July, so it's okay. I'm going to declare it in July. Well, no, the contract needs to sign in July, right? And so it's some of these little things where people have no idea. And some of these mistakes are very expensive to fix. And last but not the least, I think it's more about the structure, right? Where do you buy the property? Is it SMSF? Is it trust? Is it personal? How do you go around building property portfolio so that you can scale up? And that's where a property investment advisor, an accountant, and a mortgage broker plays a really, really important part. Where are you placing these to avoid stamp duties or managing land taxes, or how are you navigating through, some of these intricacies so that, you're not hemorrhaging your property portfolios in the future or getting caught by GST rules or double stamps, or, there's so many things that can basically get triggered. And, typically if you round this about, I think I love your analogy that, put the property investment advisor in a bubble, and then you have all of these various different connections that are happening through where property investment advisor basically is the catalyst to drive all of these conversations.
Yeah, and you spoke about a handful of things there. I wouldn't make a property investment decision without speaking to my accountant, whether it's buying or selling or otherwise. Little things like, a contract dated the 30th of June versus the 1st of July can have a huge ramifications, not only in the tax you pay or the capital gains tax contribution to it. It can completely change your cash flow position as well. It's such a big deal. So you've got to ask these questions, and you've got to be able to have a relationship with the accountant so you can just pick up the phone and speak to them, and they're accessible and available, and make that happen. But I hear horror stories of people still getting this stuff wrong. Do you find, Sahil, that you're seeing a lot more people investing in sort of trust-based structures or SMSF type structures? And I spoke to my mortgage broker just the other week, and she said that they're doing so much more SMSF lending these days because people, because of serviceability, getting tapped out investing in their personal name, and the next sort of cab off the rank normally is their SMSF before they start investing in trusts outside of SMSF. Have you seen that propensity?
Yes, yes. When a client they come to us, sometimes they don't even know what trust is or how to invest in a business structure, true business structures. So again, we try to educate them and let them know that whenever you start your portfolio or wealth creation journey, when you go on your wealth creation journey, start with family trust. If you don't have a SMSF, SMSF is a special kind of trust. But whenever they start their journey, we ask them to consider buying properties or start their journey in a family trust or discretionary trust environment. Most of them, they don't know. If they're already a property investor, they have one or two properties in their individual name, they kind of stuck getting more boring. Then they come to us and then we discuss and they say, look, if you had this property in your trust, that could not, this, you could avoid that problem getting more boring later on. So yeah, trust is the way of to go when you are creating your portfolio of investment properties. SMSF, again, yes, it is getting popular. Lots of people are buying properties in SMSF because you can borrow an SMSF, you can purchase a property in there. You have to be careful what you're going to purchase in SMSF because you can't just buy a normal negatively geared property. You can, but it's not going to work for you in that sense. So you need to speak to your accountant about whether you should buy property in SMSF or not. Yeah, so lots of people coming and now they understand why the trust structure is important or buying outside individual name is important as well.
And there's consequences investing in the trust. It can be more expensive from an accounting point of view, but it can be a lot more expensive with a view towards land tax and stuff like that, right? And this is where you need really smart advice around it, don't you?
That's right. So yes, it could be costly to manage a trust. Setup cost initially, there's some outlay there, but in the long run, it depends. What do you want? 5 years, 10 years, 15 years. If you have a goal to create your portfolio using investment properties, then you have to pay that kind of cost. It's worth spending that much money initially to get right advice and get the right structure in place so you can grow your portfolio for the next 10 years, 15 years, 20 years.
Yeah, it's look, I have multiple trusts. I invest in property and trust. I don't have anything outside of it. Works for me for a whole bunch of different reasons. Yeah. Everyone's going to be unique and different. So just don't do what you think you should do because you listen to this podcast. You actually need to go and speak to an accountant and actually explain to them what your plan is, and they can best shape that. But the only way you're going to know what your plan is by speaking to someone who can help you with that plan. You can try and work it out yourself, or you can actually go to someone like Moxon who will support you in that long-term planning. And most people in property, most people that tune in this podcast, they get excited about what property to buy and where, right? That's a very small component of investing in property. It's about long-term, decades view or even a generational view towards building a portfolio. Moxon, how many people come and see you with this view saying, oh, look, I want to build a large portfolio that my family can benefit from for generations? Does that happen?
For us, it's every client. I don't talk to anyone unless and until I do a strategy. So because, it just doesn't make any sense not to have a plan in place and then go out there and buy. I always say this, that, buying a property is a process, and actually the property buying in itself is the tail end of the process. That's the last of the last step. The first and the foremost is, having a plan in place. How are you going to achieve what you're trying to achieve? So yeah, I would say we acquire about 240 properties a year. We service about 150 clients a year on average, with, people coming in and buying 2 or 3 properties every year. And the intention always is have a plan in place, monitor and proactively, review that plan every 3 to 6 months, making sure that the portfolio is doing what it's supposed to do. The property is doing what it's supposed to do and treating it as a business. And I think that's where you would read a lot of benefit out of it.
Yeah, you are in business. You're in the business of providing rental accommodation. It is a business, and if you think otherwise, you're probably doing the right thing. Property is not some glamorous exercise of showing how flamboyant you are and choosing what curtains and soft furnishings you put in stuff. It is a business, and it's all about the P&L. It's all about sort of tax planning. It's all about asset creation. It's all about long-term asset creation and how you leverage them. But, there's a lot of technical aspects of investing in property that only an accountant can help you out with. And I've got a couple I want to run past the hill to get some sense on it and stuff you probably heard about but might not understand. We'll just go to a quick break. Stay with us, back in a moment. Welcome back. Phil Tarrant for Smart Property Investment Chat with Mox and Reza and Sahil Merchant, the guys, the accountant and the property investment advisor duo behind Investor Partner Group. Now, Sahil, everyone sort of talks about this 6-year rule around principal place resident, or if you're rent vesting, stuff like this. Can you give me a sense for that? Can you explain? Because a lot of people are still confused about it. What is it all about, mate?
Okay, so yeah, you have a principal place of residence where you live, and for certain reasons, you have to move out of that principal place of residence for work-related activity or something else, and you wanna, so that principal place of residence, you can rent it out. You move out, you live somewhere else because of your job or school for the kids. So while you're renting that property out, you have 6 years. You can classify that property as principal place of residence. And when you sell that property or within 6 years, you still claim capital gains tax on that property because you can classify that property as a principal place of residence for that period. So that's what the 6-year rule is. It could be a good strategy for certain clients if they can't invest in a property at this stage, so they can use that property to earn some income and don't pay tax within the 6 years. So if they can move in that property within 6 years, it will reset their 6-year rule again. And then after a while, they move out and then the 6 years starts again. So that's what 6-year rule is for. It is in relation to capital tax exemption for the principal place of residence.
And you can only have one principal place of residence at any point in time. So if you move out of that property and then you move into another principal place of residence, and you rent that property out and you, for whatever reason, you don't live in the new principal place of residence anymore, you've got those 6 years.
Correct. That's right. So you can have only one property at a time as a principal place of residence. If you move out and you're renting, you're not buying, you did not buy any other property, you don't have any other property which you can classify as principal as a place of residence, that property can still be, say, CGT exempt.
Yeah. For that period of time. And do you find Moxon, there's a lot of people's sort of first foray in a property investment is that their principal place of residence becomes a investment property?
It does. And there are a few catches that I always say people to think about when they are playing the 6-year rule or using the 6-year rule. I shouldn't say playing the 6-year rule, using the 6-year rule. The valuations play a really, really important part in the 6-year rule. So when the property basically goes from 6 years and, you are now, the rule basically comes in where now you're going to pay the capital gains tax. There is a line in the sand that basically gets drawn. And so again, using this as an example, you buy a property for 500, you're living in it and you decide to move out of it. You want to make sure that, you're triggering the valuations at these milestones. As you move out, you're triggering a valuation, as the 6-year comes to an end, you're triggering another valuation and you want to make sure that these valuations are as high as possible, right? So to a certain extent, maybe inflated, because valuations are so, I would say, they're very quantifiable, right? You would go to different banks and they'll value your properties quite differently. And so, you want to make sure that in order for you to not expose yourself to maximum capital gains tax, you're getting those valuations done and parking it and banking it because, these are self-driven valuations. You don't have a valuer going out there doing these valuations for you from a tax office perspective. So, playing that rule properly or using that rule properly is quite important as well. And, as a property investment advisor, when I'm talking to these people, I always say to them, well, the rule is there, yes, for you to use, but make sure that, you're using the valuations to your advantage as well at the same time.
So this should be a consequence to your property investment journey rather than the core focus trying to use this 6-year rule as the main driver for how you shape your property portfolio, because it's really going to stifle you from doing too much more. Like you might be able to have one property. Yes.
And importantly, is this the right property for it to be converted into an investment property, right? So are your expectations that this property is going to give you future growth, or this property is a development property where you can do, subsequently, more adding value to that property and take it to the high best use? And so those are some of the key things to consider before you put that property into your property portfolio. Majority of the times people like overinvest when they're buying a property to live in. And so every time you're going to convert it into an investment property, these are significantly negatively geared properties. And, naturally these properties also sit in their personal names. You can't buy PPORs in, trusts as well. So, it impacts your servicing pretty much right away. So you need to think about some of these things very carefully when you're divvying up your property portfolio as well.
And this is assuming, Sahil, that you continue to rent. So just that point that Moxa made. So you've got 6 years, and then after that 6 years is when they'll start calculating capital growth from, not from when you originally moved out of it. So you've got a 6-year gap of.
So you can use the substitution rule. This is called. So you can use your valuation at the 6th year and use as a cost base to calculate your capital gains, and then you pay on the growth after that. Yes.
Yeah. Okay. Which can be effective, right? It's more of a tactic rather than a strategy. And another sort of, it's quite a technical question, Sahil, is from what I understand, a lot of people don't know that if you're buying as an investor a house and land package, or you're developing something, that there is GST consequences for you should you choose to divest that property within a particular period of time. I think this something that's not very clear.
That's true. I mean, most of the people, they don't know that when you buy a house and land for investment purposes and you sell that property, you have to pay GST on it because it's a new dwelling. So GST is applicable on the new dwelling when you sell them. So if you sell within 5 years, then GST is applicable. So lots of people, they go into this house and land packages because they want to this is the plan they have for their investments. They don't realize, or they don't get advised, that when you sell this property, you have to pay GST on it because it's a new dwelling. There's a rule from tax office that if you sell within 5 years, the clawback is there, you have to pay GST. After 5 years, you don't have to pay GST on that. But then you are locked out in that portfolio. You can't grow your portfolio there because you can't do much, because you would be exposed with the tax bill if you decide to sell to release some cash for the future purchases, for example. So yes, so it is very, very, it's not many people know about this kind of rule. So we try to educate them, let them know that when you get into this house and land kind of investment, then GST is coming for you.
Yeah. And so this, I guess you would view it as an account as a contingent liability. It's a liability should you do something within a particular period of time. Then after 5 years goes, how does that sort of, does it have consequence for the purpose of refinancing? Trigger anything if you finance that property during that period of time if it's development stock?
No, from a refinancing perspective, it does not really matter. It shouldn't really matter, because from a bank's perspective, that GST liability is there, or if that decision is made, and so your strategy is hold strategy, not sell strategy.
Yeah.
But interestingly, what tends to happen is that because a lot of people don't know about this GST side of things, they would have majority of the times bought these properties in their own personal name, and so you can't even use margin schemes, or you can't even claim the builder's GST back. And
that's true.
So there is no net effect. Like, you buy a $700,000 property, or you build a $700,000 property, for example, and you have a bill of almost $68,000 right at the core, right? And then you can't go back and say, oh, I'm going to, or, there might be ways to manage some of these things. But ultimately, if you don't have an active AB and you're not registered for GST, that bill is there for you to, hold on to till 5 years basically passes. So, and if the property doesn't grow, it's a double whammy, right? So,
if it goes backwards, which often happens sometimes in these situations, if you are buying house and lands in rich greenfield sites where they're just pumping them out left, right, and centre. So this is a big deal. So you've got to make sure you speak to your accountant. If you're going to go down that pathway, you got to really understand from your property investment advisor all of these ramifications around it. And a lot of people will be sitting there, the mind boggles. We're just talking about two specific instances here. This 6-year rule with capital gains tax exemption, and then now also a GC component of a house and land package. It's not even entering people's mindset. It's the old adage that they're unknown unknowns for a lot of people, and you're not going to know about these things unless you actually speak to someone who's going to interrogate.
That's right, 100%.
Yeah. It's I know people who have found themselves get quite stuck in that regards, and it's only when they sort of get on that pathway they go, why didn't someone tell me this? at some point in time. You say, well, who did you speak to? They go, I spoke to a property marketer who sold me the property on the basis of the depreciation benefits, right? And the net negative gearing cat. Like this still happens, mate.
Yeah. And a lot of people don't think about like depreciation, that, depreciation ultimately is a temporary benefit. It's a cash flow impact, right? You're claiming it now, but when you sell your property, you have to pay all the depreciation typically back anyway to the tax office. So, if your cash flow is okay and you're saving good money on a monthly and an annual basis, then a lot of this is like a moot point. You shouldn't even be thinking about depreciations. And again, there is a massive stereotype that there is only depreciations with brand new properties and not old properties. Old properties offer the depreciation benefits as well. You just need to, manage some of these things as to how old the property is. So see heaps of stereotypes around this as well.
There is heaps serious. So, well, the tax office made some big changes. I can't remember what it was, 2015, 2016 around depreciation. And they changed on, I think it was scrapping or plant equipment or something like that.
Yes, but still the building depreciation is still available to a lot of people at 2.5%. So that still is something rather than nothing. But again, as I said, a lot of these depreciation benefits is typically cash flow impacts. You claim it now, you get the money back, but as soon as you sell the property, the tax office is there saying, well, you've claimed these depreciations, now it's time, and it reduces your cost base, right, Sohail?
Yeah, that's right. So you have to add back that depreciation, because basically what you're doing with depreciation when you're claiming them, you're deferring your tax for future. Whenever you sell the property, you have to add that depreciation back. Lots of people in past years, they were double dipping as well. And then it was coming very hard now and getting stricter day by day, especially the rental expenses. People claiming lots of renovations, this and that. And then they don't add back when they sell the property. So they are basically double dipping there. So depreciation is a temporary benefit, as Moxin mentioned. And it is for some people, it might work. But when you have a longer term strategy, this is not going to work for you. So if you're just thinking about getting the tax back from the taxman, then yes, negative gearing can work and you can get some benefit now, but you're not thinking about long term then.
Yeah, 2 points I'd make there, Sahil. Number one, you got to make sure you got a good accountant on the sales side of things, because if they get that wrong, the tax man will spot that. And we've had people from the ATO on this podcast before, and we like to bring them on for the purpose of education. There is such good data matching now within the sort of different regulatory bodies that if it might not be anything nefarious on behalf of your accountant, they might not just know about the rules or get it wrong. But you don't want to be doing that. You want to make sure it's absolutely squeaky clean. But it surprises me now how you still see properties being marketed to property investors, Moxin, that says after tax, this will be cash flow positive, right? Because you've got to take depreciation into it. So it's a strategy. Just be clear, depreciation is not a strategy.
The byproduct. Basically that's what it is, right? It's a byproduct of, your value of the property and a temporary cash flow impact, right? So,
This way has been a good advice. Any other advice for our listeners, Moxa, when you're sort of considering how an account can play a key role as a strategic partner with your property investment advisors? What do you got to get right, mate? It's a closing remark.
Look, I think the holistic approach in property investment is very important. That collaborative nature of events with, property investment advisor who can provide you that comprehensive support and provide you some of these answers to some of these questions proactively, not reactively. I think that's the key to, you understanding your financials and your tax implications and, how does that impact your investment decisions? And again, regularly review your strategy, stay informed about the market, bring these people in. A lot of people see accountants once a year. Like that's not on. Like if you are in a business of running real estate or building a property portfolio, that accountant that's going to charge you like $300 a year is not the accountant that you're looking for, right? You want to make sure that you are investing into an accountant, investing into paying the taxes, investing into a right property investment strategist, and having an astute mortgage broker on the team to bring it all together for your home.
Yeah, absolutely. And I've got my accountant on speed dial, and a good accountant will keep you accountable as well.
100%.
It's true.
They'll say, you said you were going to do this, you haven't done this, why haven't you done it? You got to do it. That's what my accountant does to me. No doubt, Seal, you do the same to your clients when, you've got to be held accountable to a vision and a strategy, right? And sometimes you need a bit of a kick up the backside.
That's true. So we always tell them, look, if every 3 months you should call your accountant, just If there's nothing else, just a social call is good enough. So maybe there's something new coming up. As you mentioned, the tax office has lots of data now, data matching. They are using AI tools nowadays as well. We are not the only one who's using AI tools. They are using the AI tools as well. They can detect if you are lying there too. They have lie detectors too. They check and they have benchmarks. They can check and verify things and things like that. So you don't hide anything from your accountant. They can guide you accordingly what needs to happen. Okay.
Good counsellor. Moxon, how do people track you down if they want to sort of learn more about Investor Partner Group?
Yeah, they can reach out to us on our website, investorpartner.com.au or helpmebuy.com.au. Of course, we have our own podcast as well called Help Me Buy Property Podcast. It's more for much more astute and, experienced investors. So, help us follow there. Yeah.
That's it. Well, keep up the good work, guys.
Thank you.
Thank you, Phil.
Nice one. It's Sahil Merchant, Tax Director of Investor Partner Group. And obviously you all know Moxon. We'll get Moxon back on the show and other points soon. Thanks for tuning in. Everyone, remember to check out smartpropertyinvestment.com.au. Social media, you can find us at Smart Property Investment, track us down there as Smart Property HQ. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.